Good morning. Welcome to episode 7 of Scott and Sam in the AM. If you haven't listened, thanks for listening. We're on all platforms, Instagram, Facebook, YouTube, you name it, at Scott and Sam Real Estate. I'm Sam.
I'm Scott.
Let's get into it. Scott, episode 7. We're here in person for the first time on our pod. Scott's up visiting me.
We're in Philly. Weather's not as good as New Orleans, but we're here.
Here's my question for you today and the title of our podcast. Scott, why can't we scale? I didn't tell him that was the title. I didn't give him any prep for this. I want it to be organic. I don't want to get into this. And we talk about it nonstop anyway, so we might as well just do it and record it, help other people.
Why can't we scale in our wholesaling business?
Wholesaling business seems like we kind of skid out as we get into our other businesses as well, and it kind of always seems to come back to us being more doers than delegators.
Yeah. I mean, I think we're going through that right now with the wholesale business, which we were up to 13 people, I think, at one point, closing a lot of deals, but the overall net profit was probably less than what we make now with just 4 people.
Yeah, crazy to think about. Yeah.
And I think the biggest thing is everything runs through us, always. And it always has, until now. And I think the only reason why we're able to do that is because we're not reliant on the wholesaling revenue like we were because of the flips. So kind of letting the wholesaling business work itself out with some down months and being less involved, and then letting the guys understand that they need to have the confidence to be able to figure things out themselves. They need to be able to get the deal done without our input, and more just like when they do bring us a problem or a question, it's more just like they're just talking to a soundboard, like that's bouncing back off of them and just saying like, okay, like, yeah, like, that sounds good. That sounds good. Okay, cool. Instead of like direct, unless they're doing something completely wrong, but like direct input, because the way that they would do it versus the way that we would do it is different, but it doesn't mean it won't get done. And I think that's how we've always made mistakes in the past, like always just telling them, hey, do it this way because it makes sense for us. But then when they go out and do it and they replicate it, it sounds shitty or poor because they're saying it how they wouldn't,
Yeah, I think we have moved so fast and done so many different levels of real estate, big and small, that there's always that like pot of gold chase that we come across of, oh, I didn't know we could do this. I didn't know we can make money this way. And it's the balance of doing that and trying to raise your ceiling, but all the while keeping your floor, because we've gone through this multiple times where like it's cool that, and it's a little, like you said, it's a little bit different now, but we went through a period where we just tried to wholesale huge stuff, like 300 unit plus type stuff, with a mindset of, well, we could just create a margin of between 30 and $31 million. That's $1 million. That's what, we hope to make in an entire year with all of our deals. And it didn't work. And we went 2 quarters without making $1, and you just deplete all of your cash on hand in the meantime. And now, you take that lesson, you learn from it, and you realize how important it is to make money every day. But then as we uncover these things, and like as much content as we're putting out, we're consuming 5 times as much. Like we're always sending videos to each other of other people, like big name guys and small name people. Look what they're doing. We should try that. We talk about development all the time and new construction. And we just, knock on wood, did our first subdivision and successful resale of a lot. Like that's opened my eyes to a lot of stuff. And, it's just balancing, like, obviously you want to have a good lifestyle and make money, but you also want to put yourself in a position for long-term wealth. I don't know the answer, but I do know a piece of the answer is more people, more help, and more delegation.
Yeah,
Otherwise it just
more
comes back to
delegation.
zero every time.
More delegation.
Yeah.
I mean, it's a tough business model to scale.
Mhm.
I've met very few people. There's only a few companies that I actually have heard of who actually scaled a wholesaling and flipping operation,
Mm.
so it's not like I'm not using that as an excuse. Like, we certainly could be better at what we do, but, or at least better at business, because we definitely understand the wholesaling side of things pretty well.
Yeah. I don't think any of, we've never set out to build the world's largest wholesaling business or anything like that. It's never been, but we understand the importance of, if you're going to be, especially a full-time real estate investor or even just a serious real estate investor, you have to have some sort of off-market marketing channel pipeline. Yeah. Even if it doesn't make $1, even if it just breaks it even, it's going to be incredibly profitable for us in the long term because of the access to the deals it gets us. It's just, oh, your cost basis is just 30 to 60% less than anything you see on the market.
Yeah, I wonder if any big time real estate developers or REITs or funds are operating with no direct to seller acquisition team, or I don't think they are.
Well, they have acquisitions teams, but I feel like those acquisitions teams are working more with brokers. And to give everyone listening some perspective, we do the full range, everything from selling a lot for $30,000 to a $3.5 million industrial complex. I'm not saying that's the right answer, but we know how to do that full range. And that kind of brings me back to like the thing we struggle with sometimes is like identifying what's the best ball to keep the eye on. Sometimes it's multiple balls, but then you need more people and more delegation. We're, 32 and 33 years old. I'm the senior alpha, but we never done this before. Like I worked for a company that's successfully scaled from a small to what I would consider like a big small of companies, and I saw a lot of little stuff along the way. We know how to we know how to make money well. Like we know how to close deals. We know how to negotiate with sellers, sell deals and raise money and stuff. We're good at that. But that's a totally different beast than hiring and managing and growing and retaining a team. And they're both super important. I guess making money is the most important because without the money you can't have the team. And I don't even know if it necessarily needs to be us that is directly managing the team. Maybe we can be one layer away from it. But and I'm not just the wholesaling is I view that as a small piece, but like I see the scalability, like where I live in the flipping,
Yeah.
and where you live is tough. It's pretty landlocked, but in the future, more opportunities in bigger markets and such. But it just comes down to hiring good people you can trust, and then return on your time.
Well, I think the other thing of it that we didn't have in the past, and I don't know if this is a bad way to look at it because it's less specialized, but like having multiple streams of income inside of one business can really help you not be so like on the pulse with one aspect of the business. Like,
Mhm.
I think that's a big part of it.
You
Like,
mean like within the same vertical?
mhm.
Yeah, yeah, yeah,
Yeah,
yeah.
like the raising money
Right.
side of things, like we're getting pieces of big deals, but you don't really make any money on the cash flow or anything like that in the short run. So you need to make acquisition fees and like, a $50,000 acquisition fee is good for, an entire month. And if you do that, that gives us the ability to go out and hire a manager one day
Hmm.
to do our property management. And then we can, off the strip centers, we can remove them and put our people in place. And then it's the same cost, but it's just going back into our account opposed to into,
Sure.
I think those things will help you get out of the weeds of your business by having just like little streams of income that are constantly coming in.
Hmm.
And I think we've been so reliant on, like, one thing for so long that which is basically wholesaling, like, either if we bought a property, we still usually made a wholesale fee
Hmm.
if it was a big property, and then if we fixed it, it's, like, still like wholesaling, you're just gonna kick the can down the road and then flip it and make a
Hmm.
fee. There's no, like, consistent fee. Yeah.
Yeah, and to give people a perspective, we were pretty intensive for I don't know 12 to 16 months on burrs, single families and multifamilies. We're like, this is great. We're burring with a low cost basis and quote unquote, making money tax free. Problem is that you can't make enough money burring to make a living as well. And then we make a living doing this. What we do is so backwards because we need to put out money to make money. And like this is really the first time in my life. Like we were talking about this a little bit last night, but I was thinking about it last night as I stood at the ceiling at 3:30 in the morning, questioning every life choice I've ever made. I've never had so much cash exposed before, but I've had the amount of cash I have on hand before and felt comfortable. But it's the fact that you don't realize it's coming back around. You know what I'm saying? Like until it does, and then you're going to do it again and put yourself in the same position. But with burrs, if someone works like a 9 to 5 job or has another business where they have a very good or solid income, I think it's an awesome model, especially if you're young and you have
Oh,
time to
yeah.
pay off the debt. But for guys like us, like we need to keep, you said this yesterday, that we need to get such a return on our money because that's how we make money.
Yeah. I mean, the burr is I think it's a good strategy to have in flux with everything else. Like we're doing a burr right now that was going to be a flip, and I think we'll make more money on the burr refinance than we would have on the flip because you don't need the property to be all it should be to flip a property. Like when you flip a house, you need the walls need to be removed. It needs to be open concept, all of these things. You don't need that when you're burring a property. You can still get the same valuation. So it's like it works in certain situations. And then more importantly, I think it really works on big scale.
Mm,
Like that's where you can make all your money and you don't need it to flip a damn property if you have the scale.
mhm.
Like if and I think we're kind of like slowly getting to that scale, but like there's
Like
even
that
a
you
level to
mean like that
that.
you mean the scale volume of deals or like
No,
that deal you're walking next week?
like that's what I'm
Yeah,
talking
yeah.
about.
And we've done that before, like, we've talked about that, like, we did it on a small multifamily deal, and we made a lot of money on it, and I can't imagine you do that on a 50, a 100, a 150, like
Well, we're walking 100 units next week, and it's 50% occupied from a storm that hit it. And we're looking at it needs 50 units are down, 50 units are occupied, and the 50 units right now should pay for the debt on the purchase price, just enough to sustain you while you renovate the other 50 units. If you do that, you renovate it, it should be worth probably like every bit of 150% more when it's fully stabilized than what you're paying for it. You refinance that, I think the numbers were like $8 million. Like, let's say you got 70% of that because you're going to take it to like Fannie Freddie, right? 5.6 million, and we're looking to pay 3 million for it. That leaves us with 2.6, and we're hoping to do the project for 1.5.
sheesh.
I mean, that's 1,000,001 in income without paying taxes
Mhm.
on that. Like, it's worth it
Yeah, it's
weight
worth
in
looking into.
gold, like, it's
And
worth its weight in gold.
what I would tell people, like, for people who have never done a deal of that scale before, look at it like this. I get nervous about it, not nervous, but I get, um on the fence about it right until we end our due diligence and we commit 100% to doing it. Because by that time, we've gotten all of our quotes back from contractors, insurance. Like right now, the only thing I'm thinking about, like, is this thing going to pencil? Because what if we get an insurance quote back and it's $250,000 a year? And, so, like you can't control those things sometimes. And then you just write it off. Okay, it's dead. Done. Waste of time. But when you get through all that stuff and your underwriting checks out, like then it just comes down to you being patient, being realistic with your numbers and stuff, and then executing on the plan.
Yeah.
And the plan gets executed as fast as you make it get executed. That's the cool thing about it. But with this multifamily stuff that he's talking about and the burrs, it's all valued off of income. So the higher you get the gross income and the lower you get the expenses, the more the asset is worth. Therefore, the more debt you can put on it. Therefore, the more money you can take out of it. So he's talking about making $1.1 million more than your cost basis tax free. Now that's still debt, but you have
But it's paid for by 100
100
tenants.
tenants paying
So
down the
if you
debt.
lose 10 tenants,
Yeah.
you're still probably covering and then some. So and it's in a strong like a pretty strong market, like, for rentals, so I think it would be, fairly safe in that regard, but I don't know, we're gonna go there next week, we might not like it. It might need way more than 1,500,000, or maybe we could do it for less, I don't know, I don't know what the condition of the units are.
It's hard. It's hard. I've made videos about this before about how Scott, when he was in his young 20s, really focused on building up a rental portfolio of like nothing crazy, small assets, duplexes, houses, stuff like that. Whereas I was focused on my active income working a W 2 sales job. And now I talk about my frustration on months when we have down months that I don't have that passive income that he has. All the passive income that we get through our businesses just goes right back into our businesses
Yeah.
because we're doing so much active construction and purchases and things like that. We need every dollar we can get.
It'll pay for, like, loans that we've,
Yeah.
like, taken out on other things, like, if we bought, like, a flip or something like that and you have a loan, then maybe one passive income, like, passive asset will just go into that account, and then they'll just bounce out, and then you're not paying for the loan, but you're also not taking any money, so
But from my experience, I'm not naive to the fact of like, yeah, it's quote unquote the plan is simple to buy a duplex and burn it and cash flow it and get your money and stuff like that. But it still takes a lot of time, a lot of money, a lot of effort. You did that over the course of almost a decade, right? It wasn't in a year. And knowing I've also managed, 8 unit mixed use building for us. And you can have a down unit or two going through an eviction or someone moved out or whatever and they don't pay. You don't feel it because you have 6 other people paying. If you have a duplex or a house and you have one person not paying, you feel it. Like, and I'm the first one to say, like, property management is not my skills. I'm trying to learn how to manage people in a business before I manage tenants.
yeah.
But That I think about that, and sometimes I think I might know too much for my own good. Maybe it's stop. What's that theory of like, you know what I'm talking about? It's like you're putting yourself in quicksand or whatever.
Well, no, explain it.
I'm saying like some people like you know so much from
That you
or you overanalyze your
overthink it
yeah
because
yeah
you're
yeah
like, yeah, people do that all the time. They're too smart for their own good.
yeah
Shout out,
yeah.
shout
That's
out.
me.
Yeah, shout
That's
out
me.
Sam. The I mean, the honest, like if you just want to get started and you want to build up a portfolio, my whole thought always was one property a year. So I was flipping houses, wholesaling houses, doing all of these things, but I need to own one more property per year every year. And eventually you get to a point where you stop doing that. But um, now it's just bigger stuff. But I mean, I bought 2 this year for
Mhm.
myself, so that's like 3. I bought 3. I bought Akron.
To give you an idea, like we always talk about this, but like I'll go back and look at some of our old deals, like flips or stuff we bought or whatever, and I'll see on Redfin the last sold date, and I'm like, wow, that was only 8 months ago. Like,
Feels like
yeah, we're moving
go.
fast, you know. But I think the thing that holds us up is that we don't get you don't get that immediate reward. Like you can work a 60-hour week, buy a bunch of properties, successfully execute on a plan, and move a bunch of deals, and then you just got to do it again. You know, like, and there's no, I don't like, there's no portfolio. It's not like you can sign to a Vanguard account and be like, what's my current real estate portfolio balance? Like, you're just like adding up a personal financial statement on a spreadsheet and be like, okay, like, I should be in pretty good shape by the time I'm old. But
Yeah.
I struggle with that myself. I'm sure a lot of people, I've talked to a lot of people who like, they own either half a dozen rentals or they own 65 rentals and they hear about us doing some of the bigger commercial deals that we're doing. And they're like, I wouldn't even know where to start. And I would say is you're already doing it. It's just more units, a little bit more underwriting and due diligence. And then it's going to take a lot more time. You know, you can burn a duplex in 90 days. You can't do that in a 100 unit apartment. That's going to be 2 years, you know?
Yeah, that's every bit of 12 months
Yeah.
probably if we're lucky.
It took us a year and a half to do our first 10 unit burn.
Yeah, it's kind of my own fault.
It is your fault.
Sam's never even been there.
Been there in spirit, been there on FaceTime.
Yeah, I mean, no, I agree. I think the biggest thing is when you start to make like decent money and you kind of see another path forward, you don't want to do the deals that quote unquote make you like $1,200 or $1,500 a month because you think it's not going to move the needle. Like this one duplex is not going to change my life. And you might be right, but
Well,
like
you might be right, but that
you
GX
also
and
might be
caviar
wrong.
is
Yeah.
1,200 bucks.
That's what I'm saying. So it's like it's like when you put it in perspective of like $1,200, and that's not a great return on a rental property, like $1,500 to $2,000 a month. Break it out per year. That could be upwards of $24,000 per year for the next 30 years, probably. I don't know what the math on that
Like
is.
750,000.
One property could cash flow
Dude just
you
takes my math as value.
I
I
don't
love
know,
it.
$750,000 over the next 30 years of your life that you wouldn't have made.
And we talk a lot about, especially people who want to keep going and keep building. Like it's a balance between like, if you want your money back and buy more assets, your cash flow is probably going to suck because you're going to put as much debt on it as
You
possible.
gotta leave the money
If
in
you
the
leave the money in the deal, you're going to have great cash flow.
you gotta
You
leave
know,
the money in the deal, unfortunately.
it's all about your level of debt. You know, like I know a guy who has bought a bunch of properties from us over the years. He called me this morning. He's like a friend of mine. He's an older guy. This guy has like I want to say like maybe a 65, 70 unit portfolio, all small stuff
But
like
paid off,
houses,
right?
yeah, duplexes, fourplexes. Like I think his biggest one's a fourplex, but he only buys cash. He owns another service industry based business that he was already pretty wealthy, but he's just been buying these properties. And he started in a bad area where he grew up when he was like our age, and now he's in his 60s and he's got all these properties, but they're all paid off.
Yeah.
And how does he afford the new ones? He makes so much in cash flow.
He just banks it up every
Yes.
couple months and
He's
then
yeah,
dumps it into a new
he's
one.
probably getting on average 18
$1,500?
more,
Yeah.
where he buys $1,800 a unit. So he's making $100 to $120,000 a month in cash flow.
Yeah. It's like
He can go buy another one cash every quarter, you know, like
that
he has no debt to service.
and
Like,
it only starts with one. Like you buy one.
yeah,
That
his
makes
first
you
his first one he
1,500
bought was a rundown apartment building in a tough area of Camden, New Jersey. But he grew up there. He knew it. He knew the guy who was owned it, and the guy owner financed it to him for nothing down.
Yeah.
And he just on his own fruition, his own dime, his own time, fixed up the units, increased the value, got a bunch of Section 8 tenants in there. And I don't think he ever even refinanced it. He's always been like anti-bank.
Right.
Yeah.
It's the right way to go.
Yeah.
It's the right way to go, especially if you have some other stream of income. Like,
Yeah.
you're flipping houses, you're wholesaling contracts, you're doing whatever you can, like and that's why I always thought about, like, alright, one deal, because I never did the BRRRR strategy up until last year.
Mm-hmm.
I BRRR'd Akron, that was the first one I ever BRRR'd. Everything else I've never did. I never even thought to do it, and now that rates are high again, like, I don't really see the want to do that,
Would you
but
just do like a rate and term? Like,
no,
because
no,
didn't you have a balloon on your construction loans?
no, they all just moved into
Oh,
long-term
okay.
financing, so I never used hard money, I just always used the local banks,
Uh-huh.
and they have 5-year terms on them, so, like, they're starting to come due. I will have to but a lot of the banks will just refinance it, again, and they'll go to another 5 years. But the only one I'm really thinking about that I actually need to do something with is probably Spruce Street. I'm probably coming up on that, and their rate's gonna be higher, and I don't know, I don't wanna put 30-year debt on it, though, that's the only problem. Like,
That is currently a
how many years
no
left?
amount.
430?
Okay, so it's not
Four
nothing.
four 440?
Yeah,
Something like that?
not nothing.
No, it's not nothing, it's a lot.
How much would you say from the day you bought that property, if it was in the condition if it was in the condition it is now, the day you bought it, how much has it appreciated to what it's worth now from just time?
I don't think it's really appreciated
All right, well,
much.
let's move on to the next section then. We had a couple questions here from DMs that we've gotten over the last couple weeks. We've got a lot of DMs. Been pretty cool.
Yeah.
Um,
Send us your DMs if you're so
what's the fastest way to learn without losing money? I mean, that's a very relative question. I've answered this before. If I had zero, and I wanted to get into real estate, the first thing I do is get a job. That's number one. I don't care what job you get. Get a sales job, get a consulting job, get a job, make money, have benefits, make money. You need to have money. You're going to need to have money at some point.
Don't you want money?
How do you know if a deal is too risky? We're actually working on this. We're working on an ebook for
Well,
this.
let's start with the first one. Let's answer the first one, I'll answer it
What's the
after
fast way to learn without losing money? Work for someone who knows what they're doing for free if you have to on your spare time, and watch them do as many deals as you can, ask as many questions as you can, and act like when Scott and I lived in Maryland, I was 23 years old. I project managed a flip for a guy who was a local flipper. And I think he paid me like $600 when the job was done. The hourly return on my investment was not great, but I learned a ton and I asked him a ton of questions. I should have done that 50 times for him and a bunch of other flippers while working a regular job. And that way, by the time I go to do it with my own money, it's much less risky.
Yeah, it's a good thing. I would say if you don't have anybody that you know or like you just are, maybe go to like an investor meetup or something and start just like introducing yourselves because there's guys in there who are like, they know what they're doing. They're not like super, super high level, but they are doing deals and they would probably be happy to let you run around their projects with them. They would love for you to bring them a deal. So join like a community or something that people are talking about this. Scott and Sam Real Estate on School. Check us out. And it's only $10 a month. But um if you can figure out how to find a deal, then you can do that with no money and then you can absolutely make money in real estate. So I think that's the most important thing to learn is like how do I find deals? And when you first get started, like surfing Facebook Marketplace and Craigslist and the paper, all of those places, there are deals on there and you just start offering people like
We wholesaled a deal that was on the market like 5-6 months ago and made like 10 grand. It was
yeah,
on the market. Anyone could have bought it.
yeah, people do that a lot. Like, we don't do that a lot, but it
No.
just like, we had the lead before it went on the market, and they were unrealistic on price at the time, but they put it on the market and realized that they're not gonna get the price they wanted, so then they accepted our price, and their agent, who was the listing agent, reached out to us, and he said, "Hey, like, they still wanna sell," and then we were like, "Okay, cool, like, we're gonna move it to somebody," and he's like, "I don't care, like, I just wanna sell it," and he did, and he signed a contract with us, and we flipped it, and we made 10 grand, so
How do you know if a deal is too risky? We have a couple like non-negotiable factors. Bad area. I'm going through this right now. Not necessarily a bad area problem. I have a flip that I'm trying to sell. I just had to drop it $15,000 last night. It's good finish work. Everyone likes the house. I did a good job on it. The problem is the off-street parking stinks. It's a shared driveway, a really narrow driveway. It's tough to fit 2 different cars on there. You can't change that. I wish I had thought more about that. Like, you need to think about it, how it's schematically going to work when you go to sell it or rent it or whatever. And it's on a very busy road. So people need off street parking. Worst case scenario, I'm going to burn the house and then rent it out. I'll make money. I'll get most of my money back, not all of it, but it's not the end of the world. And I learned my lesson. But thinking about how things schematically will work, not only when you go to sell it, but also when you do the project. Like, doing that project was terrible because I couldn't put a dumpster in the driveway because I share it with a neighbor. So every time we were doing demo, I had to get a dumpster to pull up in front of the house on a busy road, a ton of cars honking and pulling, but it was terrible. I'll never buy a house on a busy road again unless it has its own spacious driveway. And then, like, nothing in bad areas. Like, if I'm ever worried about like my safety, I won't go there or buy there. And I don't think you're missing anything in those areas. Oh, I live in Philadelphia. Go look at like North Philadelphia, Chester, most of West Philadelphia. There is so much active inventory because no one wants to live there. So yes, you can pick up a flip for $40,000 and spend $40,000 on a garbage flip. And in theory, it's worth 150, but it's really hard to sell. And there's 5 others just like it on the same block. And then, like, when we do deals in the South in a flood zone, something in a flood zone, unless it's a very low premium, that's a really sunken cost and it's very hard to resell it. And anything like with condos, HOA fees, stuff like that, that's just garbage sunken cost. It's lighting money on fire. What else?
Yeah, I would say, for one, listening to that story, you don't know what you don't know. So you're better off just going out and trying to gather all the information you can and then doing the deal. And then you're going to come across something like that where the shared driveway is a problem for a dumpster and then the neighbors being in pain and then that people don't want to buy it and blah, blah, blah. Now he won't make the same mistake because he actually did it, not because someone told him that. Because someone has told you don't do that before.
You're like,
Like
I'm that
yeah,
someone.
someone has told you this in the past, but you have to kind of go through it. Most people. And then the other thing is like, what deal is too risky? The blanket answer I have for this is if you lose everything and you won't be okay, it's too risky.
Yeah. Even if it's a good deal and that's the answer, it's too
Yeah.
risky.
Like,
You'll never see me finding the deal where I'm like, hey, if this deal goes south, it's
yeah.
not good for your boy.
Like if I put all of my money
Yeah.
into something where the point where and a lot of people do this, like they just don't
Yes.
have enough money to if X, Y, and Z go wrong, because they most likely will, and they don't have enough money, and then they finish the project poorly, they don't finish the project at all, they're fixing up, a tenant moves out, now they can't cover the mortgage. There's so many things that can happen when you're just operating on the fringe of your financial capacity, and if you're not there yet, you need a partner who has the money who can, you need to save up your money, or you need to finance it in a completely different way. Because if you don't do those things, then if you're on your own, you don't have the means to do it. Like you only can borrow for so long. Like that'd be my biggest advice.
Mm-hmm. Mm-hmm.
And it's just less stressful, man. It's not worth owning real estate if you can't afford to own the real estate,
Yep.
which sounds crazy, but
No. Owning real estate is the
expensive.
same as it's like owning, for the most part, a less labor intensive business. It's
Yeah.
not as many moving parts. Like, it's expensive.
Yes.
On any given day, I sit at my desk and write $3,000 to $5,000 worth of checks. I probably do that 3 times a week between materials, labor, every quarter, tax bills, insurance bills, all that stuff. Like, when you have a portfolio going, it all adds up. Utilities, crazy. Like, and you can't be doing that digging into your personal. It has to be educated. And you do that before you buy the property. That brings me back to my point of like, if I'm at the closing table shaking my hand over like, oh my God, I can't believe we're doing this, I should not do it. I'm better off walking away and risking losing the deposit or let them come after me, whatever. But there's no emotion behind this. Like, you're buying your house to live in with your family. It's going to be a yard for your kids and you're in great schools and you're excited. You're like, damn, this is going to be tight. I just got to keep working hard. Da, da, da. I get it. Like, I get it. I've been there. I'm sure it'll work out.
Don't do
If you're
that.
doing it for an investment real estate,
Yeah.
no. Like, you're better off putting it in a Vanguard index fund and let it continue to climb and make more active income. You make more active income, you can buy better assets anyway. And trust me, the better the assets, the more opportunity to make more money, the less labor intensive it is, the less headaches it is.
Yeah. Yeah, you have to figure out how to make money first. If you're self-employed, if you have a good W-2 job, then just roll with that.
If you're and I wish someone told me this. I didn't know this. Like I didn't know where to get the loans, like how much I needed, what kind of credit I needed. If you're making 150, $200,000 a month
a
in
year.
a year, 150, $200,000 a year. I'm
Then
sorry.
if you're making
And
that a
you're
month,
and
then
you're
log off here right
yeah, if
now
you're
and
making that a
stop
month,
listening
I
to
quit my
us.
job. I work for you.
Yeah.
Uh, if you're making that a year, 150, $200,000 a year W-2 income, you can absolutely start buying investment real estate. I'm assuming like you're single guy or gal, no kids or no huge liabilities, but like that is more than enough money because you can save $10,000 in 90 days as long as you're not a doofus.
Yeah, if you're frugal, you can. Or you could, let's say you do have kids and you want to get started, but you have a good W-2 paying job. Like, I bet you've probably been contributing to your 401k that you can borrow against. You don't need to borrow all of it, but 401ks add up pretty quickly. You might have 30, 50, 60 grand in there. Like, can you borrow 20 of it to go out and do a burr? And then once you burr it out, you get your money back,
Yeah, unless you live in like
pay it
a
off.
top 1% market, like we have a guy in our coaching group, he lives in Los Angeles. Little different, right? Like it's hard to get an entry point under 500,000 there. For the rest of America, we talk about this a lot in our school community about the mushroom approach. Like I live outside Philadelphia. We never go into Philadelphia. And if I am going to Philadelphia, it's not the creme de la creme Rittenhouse Square areas. Like I'm not going to get any sort of return on my money at that. I'll go back there when I'm 65 years old and I want to wear penny loafers all day. In the meantime, we're going to the areas around those markets. Scott lives in New Orleans. We're going to the areas around those markets. You don't have to be in Midtown Manhattan. Go to Connecticut. Go to Long Island. Lots of parts of Long Island.
Westchester,
Westchester, New York, North Jersey.
Hudson
Like,
Valley.
as long as it's within 90 minutes of you, you can get there twice a week. That's really all you need.
Yeah, you shouldn't be going to projects every day anyway, especially if you have an actual job.
Yeah. Or if you're just not a terrible manager like myself. All right. The last question was, if you had to start over with just $10,000, where would you begin? I feel like we've kind of crossed that bridge, but that's a big question we get. I only have 5,000. I have 10,000.
Well, if you have $10,000, you got to ask yourself, what is your goal to just own investment real estate? If that's the case, you can absolutely buy something with $10,000 and get all of the $10,000 back, have a cash flowing asset.
And how long can they get it back?
It depends on, I mean, at 90 days, 6 months max, probably.
If you buy a good deal.
Yeah.
You have to buy a good deal for that.
Sure. You do. And it can't be like a crazy renovation job because if you only have $10,000, like you can't do that anyways. You need to go in because if you borrow the renovation money, you're fronting the renovations, then you're getting paid back as the project goes. If you only have $10,000 that you put down on the project, you're not going to be able to do that. So you might as well buy something that needs nothing but paint and maybe some fixtures. I don't know, like
And
hardware on your cabinets or something.
And locking in some better leases.
Like, and then you just go and get it leased up yourself. You paint it yourself. That's pretty much it. Maybe put some snap together flooring down or something like that. Put some new numbers in a mailbox and turn all the lights to LED and put that thing on for rent. Maybe swap out an appliance or two if you have to with some used ones off Facebook Marketplace. In 30 years or 25 years, whatever debt you put on that property, it will be paid off.
And if you don't want to think 25, 30 years out, I bet you in 7 years, it'll be worth a lot more and your equity will be a lot more. All you're trying to do is create that gap between whatever the market value is, which is what it's going to appraise for, and what you owe on it. And when you do a refinance like he's talking about, that gap's going to be very small because you're going to be taking out as much as you can to pay yourself back.
75%.
As time goes on, rents go up, small increments every year, every other year. You want to keep doing increments because you don't want to go 5, 6, 7 years and not increasing rents. Then you can't go to your tenants and expect them to pay market value. They haven't been ticked up in 7 years.
Yeah, they're not going to stay in your property that long anyways. They're most likely going to leave. I think the average, we just saw this, was 2.5 years on a cash paying tenant and 7 years on a Section 8 tenant. So, and you can apply for Section 8 rental increases just through them, and then they will work it out with the tenant. But as people move out, you just tick it up a little bit, like $50, $100 a month. And then if you get it, cool. If not, that's okay. You could drop it back down. But, they say rents double every 10 years. And guess what? Your fixed rate interest loan is not doubling at all. It's staying the same, right? Other than your taxes and insurance, those are going up. But the debt you actually
What's the difference in the rent that you get per unit for your first investment property from when you bought it to today?
Let's probably almost 10% on some stuff has
Okay.
gone up about 10%.
In 9 years?
No, no, no. I bought my first property
Oh, 20, yeah,
7 years
7 years,
ago.
7 years. So it
So
wasn't rented until 6 years ago.
yeah, so probably like well, I rented the downstairs when I first moved in, and it's gone up by about 10%, so a little bit more. Um, and then the other
And
stuff,
he's renting that out basically per bedroom to students, which is always going to give you the highest premium other than an
yeah,
intensive short term rental,
yeah, yeah, short term or medium term rental.
which we don't do. Like I've heard other people talk. We had, the Fi couple on, they were talking intensely about short term, medium term rental. Of course, like if you get someone to pay a premium per night, we own an RV park, see the same thing. Someone's always going to pay more for one night as opposed to staying there for 6 to 12 months. Just economies of scale. It's also a whole nother layer of time and labor.
But if you have 1 property or 2 properties and, like, the difference between you making $1,000 a month or making $2,500 a month is worth your time to go
Sure.
in there and furnish it and clean it and do all these things while people okay, like, yeah, do that. Like, if your bills are only $5,000 a month and you can wipe them all out between 3 properties, like, that's financial freedom, dude, like, 3 properties. Like, unfortunately, my bills are no longer $5,000 a month, so, like and I bet you a lot of you guys out there are, like, is between what, $2,000 for rent, $500 for your car, insurance, like, going out to eat, like, $5,000 goes pretty far for a single guy,
Yeah,
gal.
if you're not married or with kids, it should be pretty easy to keep your expenses between like the $5,000 to $7,000 range. Once I started having kids, it got tough. But I'm also an anomaly. I'm self-employed. I pay a lot for health insurance. If you have a W-2 job, you're not seeing that come out of your check.
Yeah, but you're also giving 40% to the government probably when as real estate owners, like, we can legally pay less in taxes.
I don't know what he's talking about. We're
He
gonna we're
actually
gonna
does.
we're gonna finish it. This was a really nice question that we got. I actually can't believe we got this. This is real. What's the best part about being a dad or a husband? Anyway,
Answer that question.
it's like I always relate it to, like, when you start a new grade as a kid and you're like, wow, I can't remember being in third grade, or even bigger when you went to like middle school or high school, and then you go back and you visit the middle school and you're like, this is a lot tinier than I think. When you have a child, it's like I literally don't remember what the day before I had a child was like.
Mhm.
And then now I have a second one, and it's kind of the same, but like it's also very bizarre because I was an only child until I was 8, 9 years old. So now to see like two young kids who are siblings in my house, very, very bizarre.
Hmm.
But
That's the best part about
it's
being a dad? I guess
yeah,
I'll
I mean, like I say this to him all the time. Like I just like that family feel of like I love when like my son runs the refrigerator and like slams the door open, and I can tell he's super, he's kind of being rude, but he's like he feels comfortable. It's his home. Like seeing him lay with his shirt off on the couch, like I like that.
hmm.
I like tripping over toys and stuff, like knowing my kids are playing with them. I enjoy that.
He's like cheaper by the dozen when, I think Jamie Lee Curtis, like, goes she goes on, like, the book tour, and she's, like, orders, like, 12 pillows to come up to the hotel
Oh my
room.
god.
That's gonna be you. It's, like, all quiet in a hotel room, and
Is the
she
mom in
can't
that the,
sleep.
the woman who just died from Schitt's Creek? Is she the mom?
No, no, no,
No,
it's
she's Home
Moira.
Alone. She's Home
Yeah.
Alone.
Um,
Television's Moira Rose.
that
Rest in
is
peace.
that is the Home Alone mother, right?
Right,
That's
yeah,
the
yeah,
mo
yeah.
yeah, not Jamie Lee Curtis. I don't know her name. But the, honestly, the best part about being a dad, in my opinion, is I no longer really concern myself with my own anxieties, fears, anything like that. I'm just thinking about my son now, and I no longer like, I don't have time to worry about myself.
Meanwhile, my son had like swollen glands the other night. I'm texting Scott. I'm like, listen, we're gonna fucking beat this. I'm googling everything on it. Next morning we go in. Doctor's like, yeah, he's got strep throat.
Yeah, it's like, "Okay, dude, that's your mother and you," but it's the shout out Carol. The,
She's still listening.
I know.
She's
Shout out
still
Carol.
listening. Good luck, pal. See you at the baptism.
Tell me if I'm wrong. Tell me if I'm wrong. I'm not wrong.
No, you're not wrong.
But the,
Love you, mommy.
oh my god. But in all seriousness, honestly, my anxiety levels and I'm not a very anxious person to begin with, but, like, they have completely gone away, like, because I'm not concerned with myself as much anymore. I don't really care. Like, he's doing good, like, I'm gonna provide for him, but, like, I no longer am the sole
Mhm, mhm.
source of my problems,
Mm.
like, which is what you are when you're a single person, and you not don't have
You're like,
kids.
that's my wife and my son. I shouldn't have said that. Can we edit that part out? Well, That's our first in-person episode, episode 7. Can we make it to 7? We're making it all the way to 7D and beyond. Hope everyone has a great day. Keep listening. Join our community on Schools. $10 a month.
$10 a month.
Come on.
You like to hang out with us.
Yeah.
$10 a month.
Just don't go get that pizza tonight and just join the community instead. You'll make way more money in the long term.
What is it? $2.50 a week? Come on. That's crazy.
Scott and Sam in the AM.